Here's just some of what the Fed did in a matter of months. Again, look at that chart, unprecedented quantitative easing. Basically the Fed can print money and buy stuff with it. It's a great business to be in if you're a central banker. You can just print money and buy assets. So that's what the Fed has done, and it increased its assets by $3 trillion in just a matter of months, and probably more. We don't even know because we can't audit the Fed. But what we know is that they have been buying treasuries and buying mortgage-backed securities and buying commercial loans, mortgage-backed securities. So it's, again, fascinating that the Fed has been, basically what that means is if a bank wants to give you money, to lend you money to buy a property, it has to have money to lend, right? And if there isn't any investor that wants to invest in housing at the time, you can't lend. So the investor is the Federal Reserve. So the banking system creates the money to buy those mortgages and keep that lending going so it doesn't freeze up. So that's amazing that so much money went into our industry to buy mortgages to keep the banks lending. How long will it last? Well, here's a chart just kind of showing what the Federal Reserve policy has been in the past. In addition to that, buying mortgage-backed securities and treasuries, buying treasuries keeps interest rates low. That's why they do that too. They buy the treasuries to keep interest rates low, and they buy mortgage-backed securities to keep banks lending. Just kind of package them up because there weren't any other investors to buy it. They were scared of real estate for obvious reasons. People lost their jobs, But in the past, look at this. The Federal Reserve usually had their overnight lending rate, I don't know, anywhere between 5, 7, 9%. You could see in the 80s it was up to 18%, and people were still borrowing money at that kind of rate. And then, of course, after the last recession of 2008, the overnight lending rate was down at 0, which means that banks could lend. They usually like to lend for about 3% more than they borrow it for. So if they're borrowing it at 0, and they can lend it out for 3%, that keeps rates low. And look how long that lasted. This last time, and it did pull us out of a recession. Then the Fed started raising rates, and it started to slow down the economy and slow down the sale of houses. If you remember, I think it was the end of 2018. Real estate sales started to slow, and they were calling it a slump. And then the Fed started easing again and lowering rates to stimulate the economy. And then, of course, 2020 happened, and it's back to 0. So how long will it last? We don't know, but we do have some clues based on futures, based on Treasury futures, that it will probably be for a few years. No guarantee there, but where's the Fed to go from here? If the Fed were to raise rates now during all of this, it would be a disaster. So they're just not going to. So the most likely rates are going to be low for a while, probably an extended amount of time. So what does that mean to us? It just basically means also that the money supply will increase because people can afford to borrow money. It's the cost of money. And also the QE, just the printing of money, increasing the money supply. And we know that happened in a big way in 2020. I've showed this slide many times before. This is the M2 money stock, the amount of money circulating. Back in 1970, before the 70s, you couldn't just print money. It had to be tied to gold. And then Nixon took us off the gold standard, and that's when the Federal Reserve could just start printing money whenever it was needed. And it was somewhat under control over the decades, went up a little bit, when the easy lending came in the 2000s, you can see more money created, more people borrowing. Then the recession, and then taking us out of that recession was in printing more money, and then boom, in just a matter of months, again, unprecedented amount of money out there circulating, being spent, being borrowed, being used to stimulate the economy. And it worked. So we saw the Dow Jones go up. We saw it tank, and boy, don't you wish you bought right here? That would have been amazing. We bought a couple things, but we're not really stock investors, but we bought a couple things and they've done really well. But those who understand the stock market, I'm sure they bought a bunch then and rode it right on back up. So the stimulus worked. It also worked in the employment sector. It worked to bring jobs back. It worked to help people who lost their jobs get by with the massive stimulus, with the Paycheck Protection Program, loans that could be completely forgiven, given to small businesses as long as they kept their employees. I mean, I think that was kind of a brilliant way to go, is don't fire your employees, we'll give you money to keep them. And you know, I think it worked in some cases. We don't know if we're going to get another stimulus package. There's lots of talk about it. We'll see, probably at some point. And what that did is kept tenants, for the most part, paying rent. We didn't know if that would happen, but back in March, it was really terrifying. But because of all that stimulus, all that money circulating, for the most part, rents were paid. So there you go. This is the National Multifamily Housing Council tracker. We found that in the single family sector, collections were even higher. And all that money, all that stimulus is helping improve on unemployment. So again, March was, look at that, low unemployment, and then boom, those were scary days. Every single week, millions of people laid off, millions of people. But it was really, for the most part, the worst in April and started to decline, and again, in large part because of all that stimulus. So even though jobs are recovering, we are not quite there yet. You can see big unemployment. We're about halfway back to recovery. But if you come across this line, you'll see, whoops, it's still recession territory compared to past recessions. These gray lines are recessions. So you can see unemployment tends to increase obviously during every recession. This one, unprecedented number of job losses. We're back again to what would be a normal recession. And hopefully continuing to improve. Some markets doing better than others. Like I said, record low interest rates, all this stimulus, not all of it, but a lot of it going into real estate. Again, I said it already, but the reason the Fed is buying so many treasuries is because that tends to keep interest rates low. It's not a guarantee, but when there's buyers for mortgage-backed securities, the rates stay low, and there weren't any buyers, so the Fed was the buyer. And that, again, says a lot about the importance of bringing housing back, at least according to the Federal Reserve. So record low interest rates to stimulate the economy further, to get people buying houses, and it worked. It worked. New home sales soar to a 14-year high as supply remains tight and mortgage rates low. This is just from August. That's new home sales. New home sales have gone up substantially, but as existing homes are selling very quickly as well. July home sales spike a record 24%. So a lot of people are saying that the home buying season that basically got completely knocked off, it didn't happen in March and April and May. This has always been the highest home buying season. It wasn't. So maybe it was just postponed till now. And then the big question, will the Fed keep rates steady? Here's how that, like I said, in most people would agree that rates are going to stay low for a while. It needs to be that way to keep until things stabilize. So what does this mean? All this money printing, what is the effect of that? What's the impact? So many people believe it will create inflation, and I kept saying that. We didn't really see it in everything. We saw it in some things. Obviously, we saw it in hard assets. We saw it in the stock market. We saw it in investments. So real estate went up dramatically. Big inflation in real estate, big inflation in the stock market. Kind of across the board, though, not so much. In fact, the Federal Reserve was trying to create inflation. They're still trying to create inflation, and they were having a hard time hitting their target of 2%. Even with all that money, they're still having a hard time hitting their target 2% inflation. So what does that mean? It means that really we're fighting deflation. We're fighting a recession, a big one. And when you're trying to fight a recession, which is basically prices going down, deflation, you flood the market with what is supposed to be inflation, but it's not, so far, it's not the runaway inflation people were expecting. It is just an attempt at holding prices steady so it doesn't look like we're having a recession. But the problem with this kind of monetary policy is that even though we can't see it as inflation, it's really the purchasing power of the dollar declines. And this is what we've seen over the years. The value of the dollar just going, or not the value, but the purchasing power, what you could buy with a dollar, has changed dramatically over the years. Now, we don't call it inflation because we're comparing with other world banks and they're all doing the same thing. So, it's all going along at the same pace and we don't feel it as much. But if you don't own things that inflate, then you're just paying more for stuff. But if you own things that are affected by this devaluing of the dollar, you really stand to gain. And this is one of the big reasons we're seeing such a divide in our country, is that those who take advantage of buying and owning the assets that are intended to be inflated, you're going to become wealthy. If you don't, you're going to be stuck with higher rents and higher prices for things. That's just the fact. That's why we're seeing more of a divide between the wealthy and those who are struggling. It's because those who are struggling haven't quite learned how to play the game. It is a game. This is not economics that you learn in school. It's a game that somebody made up and we're stuck with it. So either you play it or you don't. If you don't, you end up paying more for things. If you do pay it, you own the things that are worth more. So that's the bottom line. Stimulus drives asset values up. And I'm not making it up. Go to the Federal Reserve website. It is their intended plan to create inflation. That's what they want. They're trying to create inflation. More importantly, they're trying to avoid deflation. Lower prices sound great to you and me, but it's not good for the economy. So they're trying to avoid recession at all costs. When I say recession, lower prices, because when it costs less to produce things, it's harder for companies to stay in business. And in a country that is so dependent on debt, if you have deflation, the debt becomes more difficult to pay back. If you have inflation, it becomes easier to pay back because the debt, as the value of the dollar deflates, then so does the debt. And that's really good, again, if you know how to play the game. If you own the debt, if you borrow a bunch of money to buy assets that are going up in value, but the debt is going down in value, then you're winning exponentially. And that's what we're seeing, even at a time with record unemployment. I mean, this is what doesn't make sense. I went through a whole bunch of slides in the beginning of things that don't make sense. So trying to approach investing these days with any kind of logic, I'm not sure you can. We've got a time where unemployment is as high as it's been at the peak of other recessions, besides the housing downturn of 2008, and yet we've got home prices going up. How can that be? There's only one reason: the flooding of money into the market, and cheap money. When you've got cheap money, it becomes more affordable for people to buy things. And this all comes at a time when the supply of homes is down. It's been down for years. You could see here's the new home supply. We way overbuilt in 2006, 2007. Then all of a sudden there was massive supply of new homes, and you had all these existing homes that were so much cheaper, all these foreclosures on the market, that there's a huge supply. And why would builders build any more homes when they could not sell the ones they already had? So a building came to I wouldn't say a complete halt, but about a fourth of what it had been, maybe even a fifth. It just really slowed down. And builders were just kind of not taking risks. We have a bunch of home building syndications, developments, residential developments all across the country. And We weren't taking risks. You're not building a bunch of spec homes. You're building by demand. You know, when people come in and they say they want that lot and that house, you build it for them, but you're not going to build a whole subdivision and hope to sell it out. Builders were just not taking that kind of risk. So supply stayed low. Plus, it takes so long to entitle. We bought the 4,200 acres in Tampa in 2012. They're just now those homes are being built. So 8 years to get that subdivision going. It's not a quick process. So builders, again, they were just going to do the little subdivisions, little one-off lots, nothing major for the most part, and that has kept supply down. So look at it with this current situation with low interest rates making these new homes more affordable than ever, because we're in many areas back to 2013 affordability. It's maybe a higher priced house, but the interest rate is so low, it's more affordable today than it was in 2013 in a lot of the US. So people are buying, and the supply of new homes is way down. And existing home supply is down as well. Again, this is John Burns' slide. Look at that supply of existing homes. So you've got low interest rates, all these people, you know, looking to put their money into a home, get out of the big cities. Think of the people who've been renting really expensive apartments downtown San Francisco, downtown New York, and saying, man, I just want to have a home. Now I can afford it. My payment's going to be cheaper than this condo I was paying for as a rental. I'm just going to buy. And that's what they're doing. They can afford, like I said, prices are back to 2013 levels. Who wouldn't want to buy something in 2013? That's what we're seeing. So the question is this going to end? You know, are we in another bubble? I keep hearing that. Is this just a bubble before it all melts down? Or another bubble, or are we just inflating the bubble to be even bigger? The answer to that is probably, yeah, probably, but it's manipulated. It's all manipulated. So they're just going to keep manipulating until they can't anymore. And so in a normal world where people think logically, you would say, yeah, it's a bubble. It's all based on stimulus, fake money, producing money out of thin air. You know, how is that sustainable? It makes no sense. It's magic. That's why they call them financial wizards. It is a bubble, but it's the bubble that we live in right now, called fiat money, money that is only valuable because the government says it is. And so if the government says it is, then it is. That's how it works these days. Otherwise, it's just a piece of paper, right? So will there be an end to this where suddenly we have another 2008 and people are paying top dollar and it's all going to fall apart in 3 months? Well, here is just some of the slides that might say, no, that's not the case.